Introduction. What's in it for me? Discover the psychology behind financial choices. Morgan Housel's The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness, narrated by Oliver Maines and Alex Vincent, takes us beyond typical personal finance questions. Sure, we often wonder, how does the stock market work? When's the best time to buy or sell? How much should I save to retire comfortably? But these questions only scratch the surface. There's a vital element often left out of financial discussions: the human factor. This is the unique, often complicated, relationship between people and their money, which Housel argues is crucial to understanding financial behavior. If you want to understand why people dig themselves into debt or let fortunes slip away, it's not just about interest rates or asset classes. It's about exploring the deeply human tales of envy, greed, and optimism. And that's exactly what we'll be diving into in the following chapters. Chapter 1. Each person's experience with the economy and money is unique. The tale of the Great Depression is well known. After the catastrophic stock market crash in 1929, the global economy spiraled into a decade of decline. In the United States, the prosperity of the Roaring Twenties came to an abrupt end. Businesses shuttered, families lost their farms and homes, and hard-earned savings evaporated. Poverty and unemployment soared, while confidence in a better tomorrow plummeted. This narrative has become the standard account, and for good reason, as it reflects the experiences of millions of Americans. But it overlooks something significant. The key message in this chapter is that everyone has their own experience of the economy and money. When John F. Kennedy ran for president in 1960, he was questioned about his experience during the Great Depression. His answer surprised many voters. The Kennedy family was already wealthy in 1929, and over the next 10 years, their fortune didn't diminish. It grew. By 1939, they lived in a larger house and had more servants than at the decade's start. It wasn't until Kennedy attended Harvard and read about the Depression that he realized how severely many of his fellow citizens had suffered. Not all Americans, it seemed, were in the same boat. Kennedy aimed to change that reality, helping to convince voters that he wasn't just an out-of-touch elitist, but a worthy leader. But it's not only the rich and the poor who have different economic experiences. We all do. The child of an unemployed farmhand and the child of a successful Manhattan stockbroker don't just come from different walks of life. They also learn profoundly different lessons about risk and reward when it comes to money. As we'll see later, this applies even to people who are equally well off, depending on their individual life experiences. For example, a wealthy person who grew up during periods of high inflation will have a different financial perspective than someone equally wealthy who has only known stable prices. These varied lessons shape how we handle money. We like to think we understand how the world works, but we usually experience only a small slice of reality. And that's the first thing to grasp when it comes to the psychology of money. We know less than we think we do. Chapter 2. Personal experience shapes financial choices. Economists often model financial behavior by assuming rational individuals who make self-interested decisions to maximize their returns. But reality doesn't fit this tidy formula. Take the example of the lottery. The average low-income household in the U.S. spends $4.11 each year on lottery tickets. Meanwhile, around 40% of all households would struggle to come up with $4 in an emergency, and this group includes many of the same low-income households spending just over $4 on lottery tickets. Is this behavior rational? Not exactly. But it's also not entirely irrational. For those living paycheck to paycheck, saving enough for luxuries like vacations seems out of reach. Playing the lottery may be a long shot, but for many, it feels like the only shot at getting what others might take for granted. The key takeaway here is that personal experience drives financial decisions. Seemingly irrational choices are more common than we might think. In a 2006 study, economists Ulrich Malmendier and Stefan Nagel analyzed 50 years of data from the Survey of Consumer Finances, a comprehensive study of how Americans manage their money. Malmendier and Nagel aimed to find out what shapes investment behavior, And their answer was clear: it's heavily influenced by economic conditions during early adulthood. In other words, personal history influences our approach to risk. Like the lottery, this isn't the kind of logic found in traditional economic theory, but it's intuitively understandable. For example, if inflation was high when people were in their late teens and early 20s, they tended to avoid bonds later in life. Conversely, if inflation was low during those years, they were comfortable investing in bonds as they aged, regardless of inflation trends. The same applies to stocks. If the market was booming in their early adulthood, they often became lifelong investors. But if the market was stagnant, they tended to avoid it. Imagine someone born in 1970. By their mid-teens and early 20s, the S&P 500 had surged tenfold, rewarding anyone who invested in stocks during this time. But for someone born in 1950, the stock market was largely stagnant during their early adult years, leading them to avoid it. Importantly, these early life influences continued to shape investment decisions later on, regardless of how the market actually performed, suggesting that deeply ingrained experiences often outweigh new evidence. Chapter 3. Modern economic concepts are still in their infancy. A toy poodle hardly resembles its wild ancestors, who once looked much like wolves. Yet, despite 10,000 years of domestication, even modern dogs often show flashes of wild instincts, chasing after squirrels with a fierce drive. What does this have to do with the psychology of money? Quite a bit, actually. The key idea here is that the economic concepts we rely on today are still in their infancy. Why do so many people struggle with managing money? Part of the answer is simply that money itself is a relatively new invention. The first currency appeared only around 600 BC, when King Oleates of Lydia, in what's now Turkey, minted his own coins. Compared to other elements of human culture, financial concepts are quite young. Consider retirement before World War II. Most Americans worked until they passed away, partly because life expectancy was shorter. Even in the 1940s, about half of men over 65 were still in the workforce. Things shifted with the introduction of Social Security after World War II, but it wasn't until the 1980s that most Americans could realistically consider retiring, as Social Security checks rose above $1,000 a month adjusted for inflation. In fact, the 401k plan, one of the main vehicles for retirement savings, was only introduced in 1978, and the Roth IRA followed in 1998. Other key financial innovations are equally recent. Hedge funds only took off around 25 years ago, and index funds are just 50 years old. Even widespread consumer debt, which fuels much of the U.S. economy, only became common after the GI Bill made borrowing easier in 1944. If we're often poor at financial planning, it's not because we're irrational. It's because we're new to the game. Chapter 4. Luck plays a bigger role in financial success than we often acknowledge. A few years ago, Morgan Housel asked Nobel laureate Robert Shiller what he'd most like to know about investing that remains unknowable. Shiller's response: the exact role of luck in success. Luck is a tricky subject. While most investors and entrepreneurs would agree it plays a part, few are comfortable quantifying how much it influences outcomes. As a result, we often overlook luck's role in financial decisions, which is a mistake. The main takeaway here is that luck plays a bigger part in financial successes than we often realize. Consider research by economist Bhaskar Mazumdar, which shows that siblings' incomes are more closely correlated than their heights or weights. In other words, if your brother is wealthy and tall, you're more likely to be wealthy than you are to be tall. It's easy to see why siblings often share similar opportunities, privileges, and environments. Parents who send one child to a prestigious school are likely to do the same for the other. But if you find a pair of successful siblings, they may not credit their similar outcomes to luck. They're more likely to believe they succeeded due to their own efforts. This reflects a human tendency to misjudge luck's role. We're quick to credit our hard work for our successes, but blame bad luck for our failures. And when others fail, we're less forgiving, often attributing their outcomes to personal failings rather than misfortune. Our culture reinforces this bias. Forbes, for example, doesn't highlight brilliant investors who went broke due to a sudden market dip, it celebrates those who made fortunes, even if luck played a significant part. This focus on success stories leaves us with an incomplete picture. To truly understand financial outcomes, we must consider randomness in our models. While we can't fully achieve Shiller's goal of measuring luck's exact role, we can better grasp its influence. Chapter 5. Focusing on broad patterns over individual cases helps make wiser decisions. Bill Gates once remarked that success is a lousy teacher. It convinces smart people they're invincible, often because they overlook the role of luck. Ironically, that's a reliable way to lose. So how do you factor luck into your financial decisions? Start by avoiding the urge to fixate on specific individuals. We often study the most successful outliers, the billionaires who've reshaped industries. But this approach can mislead us. The key insight here is that focusing on broad patterns, rather than specific cases, can help you make better decisions. Consider John D. Rockefeller, one of history's most successful entrepreneurs. When faced with laws that restricted his ambitions in the oil industry, he simply ignored them. This disregard was so extreme that a judge once compared his company's actions to theft. In hindsight, Rockefeller's vision seems daring, like he wouldn't let outdated laws hinder progress. But had he failed, would his behavior still seem admirable? Probably not. He'd more likely be remembered as a cautionary tale. Much of his success came down to luck. A few different rulings or political shifts could have changed everything. And luck, as it turns out, is nearly impossible to replicate. Even if you mirrored every move Warren Buffett made, there's no guarantee you'd achieve the same results. Instead, analyze patterns that are consistently effective. Studies show, for example, that people who control the structure of their days tend to be happier at work. Unlike extreme outliers, this is an actionable insight you can apply immediately. Chapter 6. Envy can drive risky decisions. Capitalism excels at two things: creating wealth and fueling envy. Take a rookie baseball player making $500,000 annually, a great income by most standards. But if he plays alongside a superstar like Mike Trout, who makes $36 million, his salary suddenly doesn't seem so impressive. This rookie now wants what others have. Similarly, high earners like Trout compare themselves to the ultra-wealthy, such as the hedge fund managers who each earned at least $340 million in 2018. In capitalist societies, there's no moral judgment against envy. But there is a practical problem: envy can make you reckless. Just ask Rajat Gupta. Born into poverty in Kolkata, Gupta rose to become the CEO of McKinsey, amassing a fortune of $100 million. Yet he wasn't satisfied. He wanted to be a billionaire. In 2008, while serving on the Goldman Sachs board, Gupta learned that Warren Buffett was about to invest $5 billion in the company. 16 seconds later, he tipped off a hedge fund manager and bought 175,000 Goldman shares, netting himself an easy $1 million. This illegal insider trading eventually led to Gupta's downfall, costing him millions and landing him in prison. The lesson: envy often leads to poor decisions, with costs that outweigh potential gains. Just as eating until you're sick isn't worth it, chasing endless wealth can backfire. Sometimes, leaving opportunities on the table isn't a loss. It's a recognition that overindulgence often leads to regret. In other words, don't be like Rajat Gupta. Chapter 7. Building wealth is easier than keeping it. Few early 20th century traders were as skilled as Jesse Livermore. By age 30, he had amassed what today would be $100 million. Just before the 1929 crash, Livermore made his career-defining move. He bet against the market and profited as stocks plummeted. Amid widespread bankruptcies, he returned home to his family with the equivalent of $3 billion. But the key insight here is that amassing a fortune is often simpler than holding on to it. Success, as we mentioned earlier, can be a lousy teacher. After his 1929 victory, Livermore began placing bigger bets, convinced he was invincible. But his luck turned, and he eventually lost everything, taking his own life in 1940. His story shows that while building wealth often requires risk and optimism, preserving it demands a different mindset. It calls for fear. The fear of losing everything you've built, Around 40% of publicly traded companies eventually lose all their value, and Forbes' list of America's richest sees a 20% turnover per decade, aside from deaths and family transfers. So, how do you hold on to your wealth? With perseverance. The most successful entrepreneurs often keep going without being wiped out. As billionaire investor Michael Moritz puts it, fear makes you cautious. It means evaluating potential gains against the risk of losing everything, which often leads to better decisions. Chapter 8. You can be wrong half the time and still succeed. Heinz Berggruen didn't seem destined for greatness. After fleeing Nazi Germany in 1936, he studied literature in California and dabbled in journalism. But in 1940, he bought a small Paul Klee painting for all 100, sparking a lifelong passion for art collecting. By the 1990s, Berggruen had amassed one of the world's finest collections, later selling it to the German government for 100 million euros, though it was worth closer to $1 billion. The takeaway: you can be wrong half the time and still make a fortune. How did Berggruen do it? According to research by Horizon Research, top collectors follow a similar strategy. They buy broadly. Some pieces turn into valuable investments, while many don't. The trick is to hold on to the gems long enough for the portfolio's value to align with the best pieces. Berggruen's collection was like an index fund. He spread his bets widely, and a few standout works eventually brought in massive returns. This strategy applies broadly. Call it the long tail, where a small number of wins account for most of the returns. Essentially, getting a few things right can offset many missteps. In investments, it's not about being right all the time. It's about making a few high-impact choices. If you're holding a Picasso, you don't need to worry about the rest of your collection's failures. Conclusion. You've just explored our summary of The Psychology of Money by Morgan Housel. The main takeaway is that financial decision making is far more complex and emotionally driven in real life than it appears in economics textbooks. Many choices, like buying lottery tickets despite financial struggles, may seem irrational but often make sense in their own context. Similarly, investment decisions are frequently influenced by early experiences with the economy rather than by objective assessments of the current market. In short, financial choices are deeply intertwined with psychological factors. So, what's the best approach? Acknowledge that luck plays a significant role, learn to safeguard what you've built, and diversify your bets.